So because we are going to learn, the whole process is basically it's merchant banking, investment banking. So the investment bankers, they help the companies to raise capital, okay, either through issue of new shares or an IPO or an FPO or a rights issue or a bonus issue, and they also help the companies to raise capital by way of loan. So we're talking about certain metrics, certain ratios, okay, which are very important for our understanding about about the stocks, okay, because after all the merchant bankers, they help companies to raise capital, okay, and they need to value the company, okay, and then they decide what should be the price for an IPO or an FPO, at what price they should issue the shares, okay. So that is the whole process what we are doing, and I'll be sharing a template maybe next time, not this time, which you people have to fill after you have some knowledge about what we are learning now, okay. So we were understanding some of the metrics or some of the ratios. So one of them was the stock PE ratio, okay. Now the stock PE ratio is what? 53.8 for Ultratech. Ultratech is the biggest cement company in India, owned by mainly owned by Birlas. Almost they have more than 50% stake in this company, okay, and they are the cement manufacturers, and they own about 23% market share of India, okay, fine. So the company is currently trading at a PE ratio of 53.8, okay. So that's a valuation, fine. And most of the companies, they trade at different PE ratios, okay. But if you look at industry, more or less they would be trading in a range, okay, very close to the median PE ratio of the industry. So let's talk about the peer group. Of course, there are 7 companies which are given here, which are being shown as listed. Let me just see if I am recording. Okay, it's getting recorded. So there are about 7 companies which you see on the screen. They are all the peer companies within the same group. Of course, the listed companies are little bit more than this, which have not been captured in this peer group. So because this constitutes almost like 50 to 60% of the sale or the top line of the cement companies. So there are some more cement companies which are there. We will talk about them a little bit when we share the template. So if you look at the Ultratech, this trade at a PE ratio of 53.8. But if you look at the right at the bottom, the median, they're about the PE ratio is about 50.34, and he's talking about 36. So maybe there are, I think, 36 companies in all. So we need to check that. So the median PE ratio is around 50. Fine. So which means that we don't look at the average, we look at the median always, because that is more representative and more meaningful. Because the average can, there can be outliers which can distort the number. Okay, fine. So the average has, not so reliable. So we look at the median to understand. So the median PE ratio is around close to about 50. So that means whatever the PE ratio is what? What is the formula for PE ratios? Market price divided by earning per share. Okay. So whatever is the market price, if you divide by earning per share, you will get the PE ratio. Okay. Now you can also calculate the PE ratio by taking the market cap divided by net income. Okay. So if you just go here and look at the PE ratio of Ultratech, so it will be market cap, which is 3,72,474, and then if you go to the profit loss, we get the net income at the bottom. So net income is how much? 6,884. So that's a net income. So you just divide and see how much you're getting. So it will be somewhere near, not exactly the PE ratio which is depicted on the snapshot here. So what you have to do is basically you have to take the profit for PE ratio, which is 6085, and not this profit. Okay. So this is 6040, but we are taking 6085. Okay, so there is a gap. How much is the gap? Basically, there is minus 46 here and minus 1, which this site has done. So there was a exceptional loss. Okay, so which has been excluded because this is not going to affect the future of the company. So there was a one-time kind of a income or loss, so which has been excluded for calculating the PE ratio. So if you look at this, fine. So here we have a loss of 57 minus 57 in this year. So there was no loss earlier. So there was a kind of a loss which happened, in this particular year. So while calculating the PE ratio, this loss will be ignored. Okay, fine. So that adjustment has been done here, but the figures are not matching. That is 57 and this is 46 because this is after tax. So so this is always calculated the loss after tax. Okay, because what has happened is that the tax has been, there is a tax benefit which the company has got because of this loss. So this has been reversed. So the figure should be minus 46. Okay, so this has reduced the profit. We'll discuss about when we do the template, okay, in detail. Okay, and then of course the minority share. Fine. So because this company may be having invested in some other company, isn't it? And it may be having some another subsidiary of Ultratech. Fine. So the 1 crore profit which is coming here, which is 1 crore loss to the subsidiary company, has been excluded. It means that. Okay. Fine. So what we do is basically whatever profit we have shown in the profit loss account, we will do two major adjustment. One will be any exceptional item, okay, either a loss or gain. That adjustment needs to be done while calculating the PE ratio. Is that okay? The second is the company may have a subsidiary. Okay. Now some profit belongs to subsidiary. Okay. When we do a consolidation, in India or anywhere in the world, as per the accounting standard, please listen here. So as per the accounting standards, international accounting standard which are applicable to India, when we do a consolidation, we consolidate all the assets and liabilities of the company as if it is a 100% owned subsidiary, but maybe it is about 80% owned subsidiary or 70%. Now Ultratech may hold some percentage of shares under the company, not full. Okay. Now similarly the profit and everything is consolidated. Okay. While calculating what is the PE ratio for Ultratech minus the minority interest, we have to make some adjustment. For the profit belongs to the minority shareholders of the company. For example, here I'll just show you a very clear-cut case because in this it is there. When we go to the peer group, okay, so we have Grasim Industry coming up. Okay, is that okay? You can see Grasim Industries. Now Grasim Industry is not manufacturing cement, but it is still coming as a peer group because it owns more than 50% stake in Ultratech. Okay. Now if we go to Grasim and then look at the PE ratio of the company, just you have to do some calculation here. Okay, and tell me. Okay, so the PE ratio is Srishti, huh? Srishti. So Srishti just calculate what is the PE ratio of Grasim? 45.2. Okay, and then if you take the current price and divide by earning per share, so what do you get? Exactly the same or different? So 2776 divided by the EPS. 45.35. So almost the same. Okay, but let's go and just see that this is the market cap. Now enter the market cap. Okay, and go to the profit loss account. Okay, fine. So since the Grasim owns lot of stock of Ultratech, okay, almost 50%, more than 56% I believe. So there are about 44% minority interest in this. Okay, so if you look at the net profit here, 8575. If you just divide this market cap by 8575, we will not get the required PE ratio. Just do that first. Huh? 50? 22. And how much is the PE ratio? 45 something. So that means we have to make some exclusion from the profit. Okay. So so we go to the net profit tab and look at the minority interest, which is about 4051. Okay. So you make this adjustment from the profit of close to about minus 4,000. Okay, so you will get the number. Just do that. So look at the net profit of the company. The net profit of the company was how much? 8575. So how much you had to reduce? 4,000 something, isn't it? So make that deduction and recalculate. You will get the P ratio of 40 something, which is shown in the screener. So the P ratio is what? 45.2. Okay, and you are getting 21 because the profit has to be lower here. Okay, so it is trading at a high P ratio and not at 20. If we take the net profit, so some of the net profit belongs to the minority interest which has been added to the profit of Grasim. Okay, because we have done 100% consolidation of Ultratech in the balance sheet of this thing. So how do we know that? So if you look at this figure, so if you go to Grasim here, and this is a consolidated. Okay, fine. So let's go to for example balance sheet here. So view standalone. If you or rather profit loss account. So here the sales is how much? 33,000. And if I say view consolidated, so it will be 1,53,000. So that means major consolidation is of Ultratech, which is getting added to this company, isn't it? And it has a minority share. Okay. So if you go to the balance sheet, you can even again look at this thing. And I'll just I've uploaded a video on minority or a non-controlling interest. So you can just view, but next time I'll be covering that here also. So look at the other liabilities of the company. Now, since all the assets and liabilities of Ultratech has also been merged with this company. Okay, this was what? Which company? Grasim. Okay, so in Grasim you have all the. So if you look at the balance sheet, so look at the balance sheet, which includes the consolidated balance sheet of Ultratech as well. But all the assets are not owned by Grasim. Okay. Since if the assets were 5 here and 10 here, 5 of Grasim and 10 of Ultratech, so it has been shown 15 in the assets here. Okay, fine. So that is basically a consolidation. As per the rule, we have to consolidate. If you own more than 50% share of another company, you have to consolidate 100%. Okay, which means there is some liability towards the non-controlling interest or liability towards minority interest. So how do we know that? So you just do this. So you have a non-controlling interest here. How much is coming? 60,304. Okay. So this is the net result of consolidation. So that means some assets and liabilities, net of it belongs to Ultratech shareholders which are not part of Grasim. Have you got it? Is it clear? Should I explain again? Anyone? Okay. Now, what I am saying is that Grasim owns Ultratech. Okay, not fully. It owns, let's say 56%. It's around that number. Okay, we'll check that in my calculations. I've done it in somewhere else. So 56% of Ultratech is owned by Grasim. So that means 44% is not owned by Grasim. But Grasim balance sheet, all the assets and liabilities have been consolidated as if Grasim owns 100% of Ultratech. That's as per the accounting standards. Okay. So since we have consolidated to match the balance sheet, but we have to show some liability, that means assets minus liabilities belonging to minority shareholders of Ultratech. So there will be a liability which will be generated when we do the calculation. I'll just show you how the consolidation is done through a simple example later on. So you understand that. Okay. When you do the consolidation, what happens? There is some kind of a liability which will appear towards the non-controlling interest. Okay, fine. So I'll just, if you want, I can just share it. I'll just share it right away. Okay. Let me just talk about the non-controlling minority interest. Okay. Yeah. Which one?
I forgot that part. Like you had said the